Hi, good afternoon, everybody. Thank you for joining us today for the Fertility, Pregnancy, and Tax webinar. My name is Yu. I manage the fertility supplement store at Fertility Nutraceuticals. A couple of quick housekeeping notes before we get started. First, this webinar is recorded. A few days after the webinar, we will send you the link to the recording so that you can review it or share it with friends. Second, if any questions come up during the presentation, please send those to us via the questions area in the GoToWebinar module that you see on the right side. We'll try to get through as many questions as we can at the end. And last, as a special thank you for joining us today, Jeff is offering a complimentary consultation to those of you who are interested. If you already opted in during the registration, there's nothing else you need to do. But if you do want to be added to that list, please let me know after the webinar via email, and we'll take care of it. Now, without further ado, here's Jeff Buffum, Certified Financial Planner and Chartered Financial Consultant at Buffum Wealth Management and Northwestern Mutual. He'll be our guide today.
Thank you, Yu. I appreciate the introduction as well as the invite. And just really, I first wanted to give you guys a sense of my background and why I was invited to talk today is that, first of all, I've been doing this about 12 years. I'm a certified financial planner, as you was saying, and throughout that time, I've been building a comprehensive wealth management team here, affiliated with Northwestern Mutual's wealth management company. We do a lot of family planning. So, you know, budgeting and tax strategies and investments and insurance planning and ultimately college and retirement planning. And so what we wanted to do today is, first of all, we wanted to hit some stats. So for example, how common is it to experience infertility? How much does it cost? And is it covered by insurance? What's not covered by insurance? As well as what is a tax deduction? What is the extent of what you can do in terms of reducing your taxes if you have infertility costs? And then ultimately breaking it down about what you can do, what you can't do from a financial planning standpoint. And we also want to go over some quick hits on just other financial planning strategies that can give you tax deductions and are family related. And then we'll leave a few minutes at the end for questions. So please feel free to put your questions in the chat, and Yu's going to help support those questions. So you know, so looking forward to spending some time with you guys today. I've got all my notes here, and the first thing we wanted to cover is just how common is it to experience some sort of infertility, and the definition of that is more than 1 year of regular unprotected sex without experiencing pregnancy, and that happens to 1 out of 6 couples in the United States. So very common. And then the typical cost of one IVF cycle in the United States on the low end can be 10 to 15,000. If you factor in add-on services like assisted hatching or ICSI, which is a specialized form of IVF, and also if there's genetic testing, then potentially it can go up to 24,000 in a cycle. There are lower cost IVF options that exist, but they do come with lower pregnancy rates. And then the medications needed for one cycle of IVF can cost 3,000 to 5,000, which depends on the treatment that's being used. And so again, it's very common that these assisted reproductive technology cycles are being used in the United States. And in 2019, over 293,000 cycles were processed in the United States, with the vast majority of them being IVF. And then also the number of egg freezing cycles for fertility preservation in the US in 2019 was over 16,000. In terms of success rates, the birth rate after IVF using the patient's own eggs for women under 35 is 47%. For women 35 to 37, is 34%. For women 38 to 40 is 22%. For women 41 to 42 is 11%. And for women over 42 is about 3%. And so even women under 35 need at least 2 IVF cycles to have a baby, statistically speaking. So, that just gives you a sense of how common it can be. And then the real question is, how much do you have to pay out of pocket, and whether or not it's covered by insurance, by health insurance for that matter. It actually varies by state, as well as the size of the company that you work for, because the larger the company that you work for, especially if it's over 100 employees, there are laws where those health insurance policies need to cover at least 3 IVF cycles, whereas if it's a smaller company, it is less common for health insurance to cover IVF cycles. In New York, the exact bullet point things that those group policies would cover would include the diagnostic tests, such as blood tests, ultrasound, semen analysis, laparoscopy, which is when the scope is inserted to view the internal abdominal organs, HSG rather, hysterosalpingogram, which is a test used to examine the cavity of the uterus, HSN, which is hysterogysonogram, procedure to evaluate the uterus and the shape of the uterine cavity, and then a hysteroscopy, which is when a scope is inserted to examine the inside of the uterus. So those diagnostics are covered, and as it relates to smaller policies, over 60% of people who have health insurance through their employers are oftentimes under self-insured policies, or again, in a smaller company, there is not the requirement to have those health insurance policies cover IVF treatments. You of course would want to double check with your health insurance carrier as to whether or not those things are covered. I also will say, just out of personal experience, one thing that my wife and I experienced, because we were lucky enough to have a son, his name's Luca, about 6 months ago, and there are various costs, and my wife and I had separate health insurance policies. We weren't under a family health insurance policy yet, and since we had 2 versions of deductibles, then ultimately we ended up paying more than if we were under one family health insurance policy, and so ultimately I think it's really important to double check exactly what you have. I did feel personally ill-advised, but the best thing to do is to double check and ideally have a family policy with ideally a lower deductible. So in terms of other things, just to be specific about what's covered versus what's not covered, is that tubal reversals, which is when the fallopian tubes are connected after tubal ligation, are not covered if the tubal ligation was done on a voluntary basis. And then insurance policies that cover prescription drugs have to cover drugs used in fertility treatments. And so, ultimately, what does this mean in terms of your finances as well as taxes? Is that, of course, and I would imagine you guys have already thought of this, but just to put it into words, is that it's very important to have a plan. Is really what's your budget and what's the most amount that you would, hope to spend on infertility treatments. And making sure that you have a cash reserve to cover that. And then ideally, if you're a family that has 2 incomes, that you want your cash reserve to be at least 3 to 4 months, meaning after expenses and after coming out of pocket for certain things, that if you have a 2-income family, that you have 3 to 4 months of expenses after that. And the risk would be that if you're out of work, you or your partner are out of work for a period of time, that you at least have time to live on one salary as well as find a new job. If it's a single income household, we would generally recommend having at least 5 to 6 months in emergency funds. If you own a business, then we would generally recommend that it's higher, that it's closer to 9 or 12 months. But as it relates to the tax deductibility of it all, the first thing to know is that the tax deduction is limited to anything that's above 7.5% of your adjusted gross income, your combined adjusted gross income. So for example, if your adjusted gross income, your salary, your income that goes onto your tax return, let's just say it's 100,000. The amount that's deductible is any expense that would be above 7.5% of 100,000. So any expense that's above 7,500 would be tax deductible. And so that's important to distinguish from a tax credit. A tax deduction is different than a tax credit. A tax deduction reduces your taxable income. And what it does is that if you were to apply your effective tax bracket, that would be the amount of taxes that you would save. So for example, let's just say your tax bracket is 25% all in, let's just say, and let's say you had 10,000 of deductible expenses, which again would have to be the amount that's above the 7.5%. The amount that you would save on taxes would be 25% of the $10,000. So that would be $2,500 that you would save in taxes by virtue of paying $10,000 of infertility treatments. And so those are technically unreimbursed medical expenses exceeding 7.5% of your adjusted gross income. And so what that includes is fertility treatments, including IUI, IVF, embryo, egg, or sperm storage, any lab fees, any medications related to infertility, any costs related to birth control, any pregnancy tests, any acupuncture, any health insurance premiums that you come out of pocket. So that's important to itemize, is that if you're paying health insurance premiums out of pocket, or if it's something that your employer is not paying on your behalf, either all of it or part of it, you want to tally up your health insurance premiums in order to calculate how much would be, in your total cost that would be tax deductible. Any infertility conferences would be tax deductible. As it relates to therapy, it's not clear whether any unlicensed counselors or therapists count, but check with a tax professional on that one. So check with your accountant, but otherwise therapy treatments that are with a licensed counselor or therapist do count. Any supplements that are recommended by your doctor do count. And then if there's a vasectomy reversal surgery, that does count as well. So the main thing about these expenses is that you want to keep receipts. So you want to make sure that you're being very specific about tallying up the amount that you're going to be spending. The other things that you would want to confirm with a tax professional that you pay out of pocket, any doctor's visits or lab work and any other medical tests, any labor or delivery costs, those things certainly do come up and came up with us. Any classes on childbirth, newborn care and breastfeeding, any hospital services, any laboratory fees, and a medical information plan. So ultimately this session is recorded if you haven't had a chance to take full notes, but really any cost as it relates to taking care of your health as well as infertility is something that you should be tallying up, and to the extent that it's above 7.5% of your adjusted gross income. would be tax deductible. If we were to break it down by trimester, assuming a successful pregnancy, in the first trimester, the general physician examination, the blood tests, and the urine analysis would be covered. The second trimester, the ultrasound, the serum screening, the amniocentesis would also be covered. The third trimester would be hospital services or any medications given after surgery. The main things that are not tax deductible would be maternity clothes, any supplements that were not recommended by your doctor. Diapers are not tax deductible. Prescriptions from overseas are not tax deductible. Any novelty 3D ultrasounds that are not prescribed by your doctor. And then childcare is not tax deductible either. So again, you want to make sure that you're having proper receipts and really tally everything up, and ultimately your accountant would be able to really walk you through it. Just so that you guys know, the other things that would be tax deductible and just kind of family planning strategies. The first is what's called an HSA, a health savings account, which is different than an FSA. A health savings account, first of all, you're able to do it if you have a high deductible health insurance plan. And what it enables you to do, you could put a little over $6,000 a year as a married couple. I think it's between $3,000 and $4,000 as a single person, that can go into an HSA on a tax deductible basis. That money can be invested, and then ultimately you can use that money tax-free to cover any medical expenses. So for example, if you foresee needing to come out of pocket for medical expenses at any point in the future, or if you just want to plan and put some money away on a pre-tax basis and invest it, then you can put that into an HSA, and you can continue to use that. Whereas an FSA, a flex savings account, is a use it or lose it. So meaning if you don't spend the money on fertility treatments, or if you don't use it for medical expenses, that money goes away. So we would generally not recommend an FSA. We would recommend an HSA. The other thing that you could do if you're in New York or Connecticut, and you're hopeful of having a pregnancy, or if you already have a child, is that you can set up a college 529 plan. There are tax deductions for setting up a college 529 plan. And for those that don't know, the advantage of setting up a college plan is that investments can grow inside of a 529 plan tax-free, and then you can use up to $10,000 of that tax-free to pay for private school before college, and then you can use up to 100% of the account balance tax-free when paying for college. Not only that, but you get an upfront state tax deduction of up to $10,000. So if you put $10,000 into a New York State 529 plan and you live in New York State, then you get a state tax deduction for that $10,000. It's not federally tax deductible like the infertility treatments. It is state tax deductible, so it reduces your state income taxes. And the same goes for Connecticut. If you're in Connecticut, same rules apply. You could put up to $10,000 into a 529 plan and get a Connecticut state tax deduction. The other thing that you could do is, from a tax deduction standpoint, is if you're not already doing it, you can max out your 401k. Money going to a 401k is tax deductible. As you may know, you need to wait until age 59 and a half in order to use it. You really want to start doing it early in life. The idea is that you're probably going to be making more money today than you're going to be making in retirement. So that the tax deduction that you get today is going to be greater than the amount of taxes that you're going to be paying on withdrawals when you withdraw that money in retirement. So even though you don't pay the taxes today on the money that goes into a 401k, and you do pay income taxes when you withdraw, generally speaking, the tax savings that you receive today is going to be greater than the amount of taxes that you're going to be paying when you withdraw. Other things that you could do for tax deductions, you may want to look it up, but it's what's called tax loss harvesting. So it means that if you have an investment that's down, then you can either sell it or switch it for another investment, and up to $3,000 of an investment loss can be used as a tax deduction for you. So if you got into Tesla at the wrong time and it's down, but you wanted to sell it and you wanted to go into another electric vehicle company, then you could claim up to $3,000 as a tax deduction. And anything above $3,000 you can use to offset future capital gains tax down the road. So these are, these strategies in terms of utilizing investments to generate tax deductions, that's something that you can do as well. Another quick hit, if you're making less than $208,000, you can do a Roth IRA. A Roth IRA is after-tax money going in. Investments grow inside of the Roth IRA account tax-free, and then you can use the money tax-free after age 59 and a half. If you're making over $208,000, you can also look up what's called a backdoor Roth IRA. A backdoor Roth IRA is for those that are making above $208,000 as a married person. Sorry, I think it's a little bit less than $140,000 as a single person. Because if you're making more than that, you're technically not allowed to do a Roth IRA. And if you got caught, you would be penalized in terms of excess taxes. So those that are above Roth IRA income limits can do, generally speaking, a backdoor Roth IRA, which means that you fund a traditional IRA and then you convert it to a Roth. So you go through the back door. You don't go straight to the Roth. You open up a traditional IRA and then you convert it to be a Roth, which will give you tax-free growth and tax-free withdrawals on your investments for retirement. The last thing that can give you tax benefits that I have prepared for today is life insurance strategies. So when you have life insurance, there's two types of life insurance. There's what's called term life insurance, and there's what's called permanent or cash value life insurance. Term life insurance, as the name implies, has a beginning and an end. So for example, it'll last 20 years. At the end of the term, the policy does expire, meaning that you have no more life insurance at that point. So the advantage of term life insurance is that it's not much money, but the disadvantage is that every dollar that you put into it is much like paying rent, in the sense that you don't get that money back, and it only pays if you pass away within that, let's say, 20-year time period. Whereas permanent life insurance, on the other hand, lasts your entire life, no matter how long you live, and also has cash or equity that grows inside the policy with tax benefits. Cash can grow inside the life insurance policy tax-free, and generally speaking, you can use up to 90% of the total cash inside the policy tax-free at any time. So permanent life insurance or cash value life insurance is more money, but every dollar you contribute to it is much more like forced savings as opposed to spending for term life insurance. And there's a variety of things that you can invest in inside of that cash value life insurance, whether it's a fixed interest, whole life type of policy, or it's a investment held inside the policy, which is called a variable life insurance policy. So anyway, these are some family planning strategies that we just want to give you guys some quick hits on and look into afterwards. I don't see any questions in the chat, but please do chime in. And again, we wanted to give you a sense of, what are the costs, what are the success rates, what are the things that are covered, and what's not covered, and then ultimately, some other things that you can do. That you can do that are family planning strategies that can give you some tax deductions and some tax benefits over time. So again, if you have any questions, we've got 5 or 4 minutes left for questions if you guys have it.
Yes, thank you, Jeff. Actually, I can see some questions. In my view, it's probably different for you because you're a speaker. Okay, the first one we have, if I were to start IVF today, would it go into next year's tax deduction?
Yeah, great question. So First of all, it would be like, let's just say 2021. So let's just say between January 1st, 2021 to December 31st, 2021, whatever expenses you have as it relates to IVF or anything else. So again, the fertility treatments, the medications, birth control, pregnancy tests, acupuncture, health insurance premiums, infertility conferences, licensed therapy, any prescribed supplements, labor and delivery costs. Ultimately, that would probably be for next year, any classes on childbirth, any hospital services, laboratory fees, or medical plan information. So yeah, so you tally it up for 2021, you hand it to your accountant, and it would ultimately save you money on the amount that you would pay for your 2021 taxes. And then anything that you pay for in 2022 would offset your 2022 taxes. So basically, the results end up coming around tax time when you see exactly how much you paid in tax after you tally up everything, over the course of the year for 2021.
Great. Next question. If my insurance doesn't cover IUI or IVF, is there a limit to the amount I can try to deduct?
No, great question. Is anything above 7.5% of your income. So again, if your income is 100,000, 7.5% of that would be 7,500. So the first 7,500 of the expenses are not deductible. Anything above 7,500 would be deductible in that example. Whereas if your income is 200,000, then anything above 15,000 of expenses would be deductible. If your income is 300,000, then the amount that would be deductible would be above 22,500, and so on and so forth. But there would not be a limit as to the amount that would be deductible. It would just be anything that's above that 7.5%.
Okay, and the big caveat here is that we do need to be itemizing our expenses in order to receive those deductions.
Yeah, great point. It is that there's two ways to claim a deduction on your taxes. One is the standard deduction. The standard deduction, if memory serves, is I think it's 11,500 per person. So if you're married, it's 23 or 24,000 in total. And so that's one way to go. And so if your itemized deductions do not exceed whatever the standard deduction is, then you would choose the standard deduction. Whereas if you're itemizing your expenses and you're tallying up your expenses, the reason why you would do that is because those expenses would tally up to be above the standard deduction. Then anything above the 7.5% as it relates to unreimbursed medical expenses would be deductible. Thank you.
Great. Okay, we probably have a time for maybe another question. Can you create 529 even before the child is born? And what if 529 is not used for education? Is there a way we can avoid the penalty of withdrawing for the reasons other than education?
Yeah, great question. So you can set up a 529 plan with yourself as the beneficiary, and then you can just change the beneficiary to be your child, after the fact. And so you can always change the beneficiary on a 529 plan without a penalty or any taxes. It's just that a 529 plan has to have one beneficiary. So it's either you or a child or a second child or what have you. If you end up not using the money for education expenses, you do pay long-term or short-term capital gains. You pay capital gains tax plus an extra 10% tax penalty. There is not a way around that. So even if your child gets a scholarship, let's say, and you have all this money in a 529 plan and you end up not spending that on education, then you can either transfer the beneficiary to be someone else in your family, either a child or someone in your immediate family, and use the money for education, or you would withdraw and pay the capital gains tax plus the extra 10% tax penalty. the thing to keep in mind is that the penalty is not the worst thing in the world because you got tax-free growth along the way. So it's conceivable that even though you pay an extra 10% in taxes on the gains when you sell, that since you got tax-free growth for, for 18 years or for 20 years, that you would have made up for that penalty by virtue of the fact that you got tax-free growth for that amount of time. Hopefully that's helpful. And then the other thing, sorry, that could give you tax benefits for college, but without the limitations, you can use either a variable life insurance if the money is invested, and similarly to the market, you can invest in the S&P 500 or a menu of mutual funds and ETFs. But you're not limited on how you can use the money. You can use it for college or for retirement or for anything that you want. You could either take a permanent withdrawal or a loan in terms of being able to withdraw tax-free from it. But that is a route that some people will go, not everybody, but generally speaking, people will not go like heavy into the 529 plan and put like all their eggs in that basket. They'll fund the 529 plan potentially up to 10,000. They'll set up an investment account. They'll set up a life insurance if mathematically it makes sense. And all those things combined can be a good way to keep optionality and save tax efficiently for down the road.
All right, great. I hope this was helpful to everyone. We have a ton more questions from the audience. Thank you. But we are unfortunately out of time. So we will get back to you on these remaining questions when we post the recording of this webinar. So thank you, Jeff, for sharing expertise today. And thank you, everyone, for joining. And have a great rest of your day.
Thank you for the opportunity, and hope to hear from some of you guys, and happy to have a complimentary consultation, see if there's any specific recommendations I can make for you. You have a great rest of your day.
Thank you.
Thanks. Take care.
Bye-bye.
Bye.